It's going to be a big week with FOMC, ECB, BOE, and jobs numbers. We have Peter Hug up next. Global Trading Director of Kitco, Peter Hug, joins us now. Peter, thanks for being with us.
You're welcome, Daniela.
Peter, let's look at the week ahead. We have FOMC meetings concluding on Wednesday. We have the U.S. unemployment numbers coming out on Friday. Over in Europe, we have the ECB and BOE meetings on Thursday. And we also have manufacturing data from China coming out on Thursday. What do you expect will come out of all this data, and what do you think it could mean for the metals?
Well, as I mentioned this morning in my blog, I think these markets are tightening up. The spread on the high-low move on gold over the past 5 days has been coming in at about $2 a day. Looks like today we may see a spread as tight as $10 on the range, which indicates to me we're ready for a break one way or the other. And there's going to be enough fundamental news out this week to create the catalyst, I think, for the break.
So, for example, if we fall short of those jobs numbers on Friday, Peter, or if taper talk continues on Wednesday?
Yeah, I mean, again, I don't think there's going to be any new news out of the FOMC. And I don't think the Europeans are going to touch their interest rate policy at this meeting. So I think the market is trying to trend higher, but it's running into selling up in the high 1330s. And this market needs to build momentum to break up through there before we see the next move, maybe to the 1357 level, which was my target last week. But the longer it stalls at 1337, unless there is some fundamental news that'll break this to the upside, I suspect that the bears might try to give it a shot on the downside.
One group, however, banking on gold, Peter, are hedge fund managers. They have increased their wagers on a gold rally. According to data from the CFTC, money managers have increased their net long positions by 26% to over 70,000 futures and options. That was as of July 23rd. Thoughts on this?
Yeah, again, it's a matter of when they got into the market. Hedge funds that bought precious metals because Bernanke finally spoke plain English and indicated he wouldn't get in the way of the market are probably funds I'd avoid. If they did buy these positions, which obviously they did, they're showing long on the COMEX. The question is, when did they buy them? And are they long in the 1200s, or did they jump into this market when gold broke up through 1300? And that makes a difference, because if they got in late, they're going to be very nervous at these levels if this market doesn't break to the upside. If they got in early, they'll hold on for a while. So it's not a question of them increasing their positions, which was the obvious thing to do after Bernanke made it plain he wasn't going to get in the way of the market. But at what level did they get in at? And again, hedge funds aren't very loyal, so you'd have to be suspect to when and sensitive to when they got in, and then determine whether or not they're willing to hold on any kind of pullback.
Peter, this is a sharp contrast to Goldman's analysts that put out their predictions for gold. By the end of 2014, they're calling for 1050 gold. Now, Peter, isn't this a bit too early or premature to be looking at gold prices for the end of next year?
Well, these guys are economists. They're paid to make long-range forecasts. Most of the time they're wrong, but let's give them the benefit of the doubt and assume they're right. And if they're right, I think what they're basing it on is that they expect the U.S. economy, if not this year, certainly by next year, to start gaining some traction, and interest rates starting to move higher through 2014, which I'm in agreement with. I do think the Fed will start to end tapering at the end of this year, and then somewhere near the tail end of 2014, probably start raising interest rates. And in that scenario, you could make a very strong case, assuming there's no other geopolitical issues, for gold to move down closer to the $1,000 price range.
All right, next news item, Peter. China, the World Gold Council, expecting it to surpass India as the world's largest consumer of the metal. They're expected to import over 1,000 metric tons of gold. Peter, what do you think of this? Are there any surprises that it should or could surpass India, given the recent import restrictions we've seen in India, as well as the Indian finance minister asking people not to be buying gold?
Well, obviously, it's the regulations that have been imposed on the Indian population have certainly dampened their not their enthusiasm, but certainly their ability to accumulate gold. And China's middle class is becoming more wealthy, and it is to be expected with the population in China that their buying appetite for gold would be probably ranked number one over the next few years.
Okay, Peter, and before I let you go, some thoughts on silver. We saw a news headline this Monday that says a new vault is set to open in Singapore this week that will be capable of holding up to 200 metric tons of the metal. I guess my question to you is, why Singapore? Why is it such a popular hub? We've seen UBS, we've seen Deutsche Bank, we've seen JP Morgan open gold vaults there. So what are your thoughts, Peter?
Well, I think the government in Singapore has been very accommodative in some of the perks that they've been offering to international businesses, especially in the precious metals area, to open facilities in Singapore. We were actually approached ourselves to consider opening up a storage facility in Singapore. From the point of view of the bigger players, Singapore is a sort of an excellent middle point hub where you can service both the European demand and the Far East demand. They've been trying to service the Far East demand out of Zurich and London, and it's been problematic. With Singapore now more centralized between the two locations, both Europe and the Far East, it just makes logistical sense, and I think that's why you're seeing those vaults opening there.
Your favorite part now, Peter, key support and resistance levels for gold this week.
Yeah, this has been a market that if you had traded the 1327 level, you would have been whipsawed 4 times. I suggested a couple of weeks back that this might be a time just to take a holiday and let the market sort of sort itself out. This market lacks conviction right here. It's trading in a tighter and tighter range, and it is going to break. There's more and more people that are suspecting the break might be to the upside, which would see the 1357 level. I need that 1338 level taken out with conviction before I'm in that camp. 1312 seems to be a good support level. It's bounced off that twice. So I think we're in a range here of 1315 to 1335 until we get a break of this wedge. But I do think that break is going to happen this week.
Peter, thanks for that. We'll see you next week.
You're welcome.
And thanks for watching this edition of For Pete's Sake. Email us at newsfeedback@kitco.com, or you can follow me on Twitter at Daniela Camboni. Thanks for watching.